Good afternoon. My name's Laura McCabe, and I'm the Director of Marketing at Sowell Management. It is my great privilege to serve as the producer for our webinar series, and so your attendance is of special importance to me personally and to all of us at Sowell Management, Rayliant, and Affinity. So thank you for that. I'm just going to handle a few housekeeping items, and then I'm going to turn the program over to Daryl Seaton. He's the president of Sowell Management, as you, I'm sure, know. We would like to encourage you to ask questions. We have a prepared program of questions, but we've intentionally left time for you to be able to interact during the panel. So please either use the Q&A tab, and you can do that using your name or anonymously. And then we also want to give you the option of raising your hand. There's a little hand down at the bottom bar, and I can make you a presenter, and then you can ask your questions live. So we'll be sending an email out, I believe, tomorrow that'll have a playback link on it. So be on the lookout for that. It'll come from Daryl Seaton. So a little different than normal, but be on the lookout for that tomorrow. So, and with all that, I'm going to turn it over to Daryl. Thank you, Daryl.
Wonderful. Thank you so much, Laura. And thank you to everybody who is on the webinar today. We really appreciate your time. We know that you're busy. And I have been really looking forward to this webinar for many reasons, but not the least of which is so that you can have the chance to hear directly from Dr. Jason Su. You all know Greg Lai, co-CIO and portfolio manager, who you'll hear from in just a moment. But the other one, of course, the other reason that I'm also very excited is that we get to talk about navigating the markets in 2025, Jason. So it's going to be an exciting topic. And among other things, opportunities for CIO to help you with your portfolios for clients. And then a bunch of interesting topics that we get to dive into. So it should be a whole lot of fun. But just to kind of rehash a little bit from 2024, Sowell Management really embarked on building out, or if you will, getting back to our roots as a TAMP. And so you all know we have our Flex platform where you can access our Sowell Affinity, or now Sowell Rayliant models, as well as some third-party managers, or if you're an advisor as PM, you can manage your models there. We also have Adhesion. And then, of course, last year, we created and formed a partnership with AssetMark, headquartered in Concord out of California, and a very robust, fully turnkey, 100% outsourced platform. And building on that, we wanted to continue this year on sort of the theme of helping you customize and personalize your portfolio recommendations to clients as we see those trends continue to pick up steam. So I'm excited today as we talk about a number of topics, as I mentioned, and I'm itching for Greg to introduce Jason to everybody. So I'll turn it over to you, Greg, and you can introduce Jason, and then we'll dive into the questions here.
Great. Thanks, Daryl. Well, I'm really excited to be here, and I know 2024 flew by, so Happy New Year as we roll into what looks to be a very interesting year. The OCIO and our team is excited to work with and expand the services that we want to provide to you, and working with Rayliant and having Dr. Jason Su on is really a first step in doing that. The Rayliant team brings immense knowledge, support that you guys can leverage. And I'm really excited about having Jason, because Jason's background, he's the founder of Rayliant. Equally important, he's a former founder of Research Affiliates. But his greatest work is as an educator. And me being a UCLA Bruin, I'm really excited to have a fellow Bruin. Jason's on the faculty there. And I think amongst many notable accomplishments and papers, really papers that bridge the gap between academia and what happens in the real world, whether it's indexing or the pursuit of alpha. But the one notable award that I love to see was his service award to the school and the student population that he won in 2009. So really excited to have Jason on board with us. And again, it's really the pursuit of the OCIO bringing to you the resources and the support and the knowledge, and particularly for Jason and Radiant. Jason's passion is as a global economist, and so he has a great world view, and we're going to get into that. So welcome, Dr. Jason. I'm going to throw it back to Daryl, and I think Daryl's going to kick us off with the first question, but I'm also equally excited to kind of hear some of your answers on where we are today in the world.
Thank you so much, Greg, and a double thanks as well, because without you, Greg, and Alex, who our advisors know, we would have never been introduced to Jason and Radiant Global Advisors. So we're incredibly grateful. But without further ado, Jason, I'm so, like I said, excited to introduce you to our advisors, because I've had the chance to spend quite a bit of time with you the last 3 days, as a matter of fact, in your Radiant offices in Pasadena, and then also in Newport Beach. And fact, we were still having dinner last night at nearly 9:30 Pacific time before I caught a red eye out of LAX back to Little Rock here to be in my office for this. But anyway, why don't we start, Jason, by you just sharing a little bit with our advisors about yourself. If you would share a little bit about your story. And Greg kind of mentioned this, but for those of you who don't know, Jason is a member of the board of directors at the Anderson School of Management at UCLA, as well as a professor in finance, among his obviously industry credentials and so forth. But anyway, Jason, share, if you would, a little bit about yourself and your background.
Well, first of all, hello to all the Sowell advisors, and obviously big thanks to Daryl and Greg for such generous introduction and for having me on the show. So a little bit more about myself. I think Greg already mentioned, if you've crossed paths with me, it probably would have been either for the Research Affiliates Fundamental Index. So, that's available through Schwab and Invesco Power Shares, or the All Asset Fund, which is through PIMCO. And so I was portfolio manager for a number of fairly large funds product that may have been in your client's portfolio. But of course, my first love is teaching. And in addition to my affiliation with UCLA, I'm also, just last year, been nominated and sit on the United Nations Responsible Investing Committee as one of their academic advisors, and been on the CFA Research Foundation, and now sits as an advisor to the flagship journal, the Financial Analyst Journal for the CFA. Now, usually, when I would say, when I talk about that, a lot of people think of, the immediate follow up to that is, you have the magic to invest and make money, right? Because of these credentials, because of these sort of scientific technology. And then, I think as we talk more later, Daryl, it is quite the opposite. And so I have much more to share as to how that technology gets applied, what it can do, the limits of that. But I'll save that for later. So just that's a little bit about myself. I'm both a educator, a researcher, and a practitioner.
Wonderful. Well, I appreciate that about you, and also I'm sure as we go through this, not only does he have amazing credentials and experience and all that, but dare I say, you're also a wonderful human being to spend time with, and very inspiring.
Thank you, Daryl.
So it's really great to have you here today. Just sort of as a follow-up to that, Jason, given your background and your connections in academia, I imagine that you and Radiant place a high value on robust research. Could you maybe just share with our advisors how this influences your approach at Radiant?
Yeah, so as I mentioned, I do a lot of research, and I publish quite extensively on systematic investing, machine learning, AI, how that applies to the investment science. And oftentimes, I would say, people think of the natural follow-on to that is there must be some magical formula that allows me to always make money, never lose money, have really high Sharpe ratio, beat the benchmark always. And that's just not true, right? The fact that I sit on the CFA's flagship journals editorial board that I consult for the United Nations is really about my ability to understand the hype and to understand what doesn't work, right? So a lot of the academic research, a lot of the computational power isn't about finding the magic that works, but it's about putting up almost this defense shield against all the hype. And there are lots of hype out there, before it was factor investing, and now I think it's a lot of the AI and machine learning investing, right? Yes, of course, man plus machine will make the man more productive, right? That's why we use Excel spreadsheets instead of just reading numbers off the Wall Street Journal, right? We have Bloomberg terminals, right? We try to do automation. It's because man plus machine is more productive. We can analyze the data better. So that is all true, but it doesn't solve the fact that in investing, you have to underwrite the risk in exchange for the return, right? If you think somehow magically there's a way to invest so that you have no risk and only get the return, you're basically signing up for a Ponzi scheme, okay? It doesn't matter whether you use a scientific, systematic strategy or otherwise. And so the research discipline is really to tell us, how much better can we do when you bring more computational power, when you process data faster? And what we know is you can do better, but there is still risk in the short run. It can still feel very, very noisy. You can be right and the market will disagree with you. And it's about compounding over time that builds wealth, right? No amount of science will change these basic facts. So don't let anyone sell you a different story, but you can do better. Yes, absolutely. With better technology, you can do better. But I would say that what differentiates a good researcher from a less good researcher is whether someone's focused on understanding the limits of the technology, understanding the limit of the data science, rather than sort of using that to hype up what otherwise I think is almost a harmful story in a harmful product construct to the end investors.
Yeah, that's very helpful. Thanks for sharing that with us, Jason. I'm going to kick it over to you, Greg. I know you have some questions as well, but before I do, just want to remind all of our advisors on the webinar, if you have a question, please make sure that you type it into the Q&A, which you'll see at the bottom of your screen, or you can also raise your hand and ask a live question of Jason as well. So, Greg, I think you've got some questions as well that you'd like to ask.
Absolutely. So, Jason, I saw you on CNBC last month, and as a global economist, you talked about potential tariffs, particularly on all our trade partners. How do you think the threat of, or actually even the actual tariffs, might impact the broader market? We hear about competition, inflation, and for our advisors, would there be any thoughts on how they might position for those?
Yeah, so Greg, first off, from what we've analyzed in terms of the initial proposal, so if you take everything that's kind of on the docket to have tariff applied on them, and you divide them into quartiles, right? And 1/4, 1/4, 1/4, and you look at the one that's sort of facing the largest tariff hit, that represents about 4% of what we import from the world. I just give you an example, right? Like we're going to put on a massive tariff on BYD, right? The biggest EV maker coming out of China. Well, they don't actually sell any car in the US. So while that might prevent them from coming into the market and taking market share away from Tesla and so on and so forth, it doesn't really have an inflationary pressure per se in that it's not what we today import and consume. And so looking at that, I think one conclusion you can arrive, and for our advisors, I think this is quite critical to communicate with your clients, is this administration, President Trump is being quite sensible, right? He wants to accomplish two objectives, right? He certainly wants to be tough on foreign imports, especially tough on China, but he also wants to manage inflation so he can give us rate cuts, right? So it would be quite counterproductive to start a trade war to increase tariff and pass all the increase in price to the American consumers, running up inflation, making a rate cut less likely, right? So he's being very practical, really slapping on big tariffs on things that we don't actually consume as much, and then leaving room to negotiate on the other basket, perhaps getting us a better deal, getting us better terms of trade, so on and so forth. But from the look of it, He is very, very sensitive to the impact on inflation, which is good because I think the big policy promise, and that's, I'm sure we can talk about this later. The big policy promise, and it's going to have the biggest impact on the stock market, the real estate market, the economy itself, is the ability for the current administration to lower rates, so reduce cost of capital for all of us, not the least of which reduce the cost of capital for the American government, right? That's I think is agenda number one. So I would say, the tariff issue, perhaps it's more of posturing to begin a new round of trade negotiation for President Trump. So it's much more of the opening offer and an invitation to everyone to come to the table and talk.
Yeah. And even today, it sounds like he's hit the ground running on interest rates and sort of talking about his desire for those to be lower. One other thing, we talked about inflation a little bit there, but recently I saw you with Frank Frabosi, which was an amazing discussion. And you mentioned something which, no one really focuses on, but it's the aging demographics. And I think you dismissed the notion that that's a slow moving train, right? That's sort of what we hear when we think about demographics. But surprisingly, you said that the impact of demographics could actually impact us sooner and in a bigger way. Can you explain a little bit of that for us?
Yeah, Greg, I mean, it is true that, of course, aging demographics moves very slowly, right? Because we all age 1 year at a time. It just doesn't go any faster than that. And most of the time you don't feel it. And the reason you don't feel it is, as we're aging from, say, 40 to 45, well, not much change, right? You still have prime working age people being super productive, engaged in the labor market. And that could continue for another 10 years for someone to go from 45 to be 55. But the minute people cross over into the 60s and they retire, what you have is then all of a sudden you have this massive retirement drove, right? Like the baby boomer retirement wave is very real. So I'll give you some statistics. Today, globally, every day, not week, not month, every day, 30,000 people are retiring. All right, that's a very large number. If you think about that, you talk about this is like 10 million people in a year globally. And over the next 1 decade, 100 million people are going to exit the workforce. And what does that mean, right? That means you have people who go from working and producing goods and services to service the economy to becoming a full-time, 100% time consumer, right? So it's not just that they stop working, it's they accumulated a lifetime wealth, right? Many of them probably Sowell advisors clients who you have helped them build up wealth, and now they're going to go spend that money. So that's highly, highly inflationary. That's like the first thing that I would say all of the advisors want to communicate with your clients. What are you saving for? You're saving for retirement consumption. And what is your biggest risk? If things get really expensive once you retire. And you think about that, right? A lot of people who save as much money as you have, and they're retiring about the same time you're retiring, and they're going to consume about the same thing you're going to consume. Highly, highly inflationary. And so it is a train that is about to hit us and hit us really hard. And I think we can feel it already, right? Post-COVID, why can't we get people to come back to the office, right? Even Jamie Dimon, and he is a tough dude and management guru, he can't get people to go back to work at JP Morgan Chase, right? He's been asking, then begging, and then threatening, and then compromising, and it's still hard to get people to come back, right? And if you're not Jamie Dimon, basically when you're interviewing someone, their first question today, like when we're interviewing, a new employee, they're asking, can I work from home, right? Can I be flex time? And the biggest hit is to our service industry, right? It's the restaurant sector, right? To the kind of offline economy where they can't afford to give someone flex time, right? Where you have to show up to office if you're working in like the restaurant business. And that's where the inflation is going to hit really, really hard. So why do these younger workers have such leverage? Well, it's because they're the only people with fresh human capital, right? The rest of us, well, we're losing human capital. We're trying to buy human capital, and there's not a lot of them around. And so we're going to settle for whatever they are willing to sell us. And so labor-driven inflation is going to be really, really big, and that's the biggest impact demographics. I'm going to pause there because I think there's also a lot more to say about demographics in emerging markets, and it as a solution, but increasing a problem. But I'll sort of pause there and see if I at least answer the first part of your question, Greg.
No, you did, and I think my takeaway was that there should be some fear of inflation through this sort of period of time, but the young people, they have the most human capital to that extent. So
They
that's what I
have
thought.
leverage, Greg. They have leverage, and it's no longer just your kids have leverage on you because you love them and you're going to leave all of your money to them as a good Asian parent. It is that all young people have enormous leverage on the boomer generation, because they have what we don't have, and it's something we can't manufacture, right? It's human capital. And in many ways, if you think about outsourcing, right, we like to politicize outsourcing a little bit too much. What is outsourcing other than, hey, we don't have enough human capital to do the work. We would like to buy someone else's human capital, have them do all the work, right? That's outsourcing, right? We say, hey, Asia, you have a lot of young, hungry people who are going to work 80 hours in the factory. Here, you do the work. We'll send you some printed dollars. You send us the goods, right? Great deal. Solves the demographics problem. But what you're facing now is they're getting old. And they also had a generation of parents saving 30% of their income. So building a really nice nest egg for their kids. So their kids also want to work from home. Their kids don't want to do factory hours, right? So I often tell my students, the fact in the US, we get to talk about our work-life balance, that, life isn't just work, is because there's a whole generation of Asian people who believe life is only work, right?
Yeah.
And that's how we get our work-life balance. But now they're starting to believe that they should have work-life balance, right? Their life shouldn't just be work.
Right.
And that's going to further reduce sort of labor supply globally. And again, inflationary.
Daryl, why don't you throw one in there?
That's good. Maybe I'll draw it out a little bit more macro here, but I get this question from my clients. I'm sure many advisors on the webinar get this question as well. But how do you see the market performance unfolding this year?
Well, there, as an economist, right? Like, one thing I do have to remind everyone, it's my fairness and honesty disclosure, is being an economist is one of the best jobs in the world, in that you can be wrong more than 50% of the time and still collect a paycheck. Right? It's quite a good deal. Now, I would say the only other better job is of course being a university professor, because in that case you're just 100% right all the time because you get to write the exam questions. Now, having said that, I will make market forecasts. So I think this year we will have a outlier year, in the sense that it's usually hard to have, I would say, 2 consecutive years where markets do 20% or better. It's just a very, very rare occurrence, right? You expect some pullback, and after 2 years of raging bull markets, things do get expensive. And so this is not me saying that things are not expensive. Things look frothy and expensive, but I simply want to sort of draw your attention. And now many of our advisors may have been in the market long enough to remember the tech bubble, right? And people were calling the tech bubble a bubble. Some even saying, this looks like a Ponzi scheme where firms with no revenue and just some PowerPoints are raising hundreds of millions of dollars. So the AI revolution is reminiscent of, I would say, the internet revolution, right? Clearly, the internet did revolutionize how we do business and created an insane amount of value, insane amount of productivity. But it doesn't mean the first wave of it didn't have a lot of bubble stocks, right? A lot of companies that didn't survive the first wave, right? You think of Yahoo.com, right? They started search and they're not around anymore, right? It's like a few iterations later, you got Google. You think of Cisco, right? Back then, they were the only game in town. They're the only people who made routers and switches that was going to connect the world. And they're a tiny shadow of what they used to be. Now most of the hardware is actually sort of made in Asia. So just, I would say the AI revolution is going to change us just as foundationally as the internet did. But what you want to watch out for is, well, are the companies that are going to win and create the most value, have they been birthed yet? And the people who believe they have the technology today, are they going to be the winner, right? So that's the unknown. But in the meantime, right, the story is so compelling. And if you have a diversified portfolio, you're going to get enough winners, probably be okay. But you're going to have some choppiness, right? But where are we? If I can use a baseball analogy, I think we're probably, inning 5, inning 6, right? Firms that are riding the AI bubble, at least the hardware makers, are having record earnings. NVIDIA still can't make chips fast enough to satisfy global demands for data center, rewiring the world for AI calculation. And I think there's a ways to go. And this year, I think that is going to continue to carry us. And on the backdrop of President Trump's, rate cut, which he reminded all of us today that he expects one, and if he expects one, it's going to happen one way or the other. So on the backdrop of this compelling AI story, where firms associated with that are still printing earnings, and you have the rate cut, I think while the expensive valuation is going to create a very choppy market, and there's some sentiment that could be quite fragile, but I do think we'll probably have a choppy market that has a upward trend. Most people, because of the sentiment, because of the compelling story, will generally be buyers on any pullback. So that's my forecast. I think we'll have another good year.
Perfect. Well, that's music to our ears. So thanks for sharing that. Greg, I'll kick it back to you here.
Yeah, Jason, and you mentioned my sort of Asian heritage. My father, he's a dyed-in-the-wool gold bug, and he's been texting me about gold all this time. And so tell me a little bit about gold and, where it is today. Should we be allocating to it? What does it mean to maybe cryptocurrency? Tell me a little bit about gold. That's a question I think our advisors tend to ask.
Right, so, well, I'm going to start on gold, and then I'll jump into Bitcoin, because that's obviously exciting, right? Like, a lot of wealth has been created. It's certainly something I'm trying to research, understand. Like, how do I help an advisor understand it? Would I ever advise them to use it? But let's start with the boring stuff, right? Gold. So, gold was the world's currency, and then the dollar replaced it. But gold is still in the background, right, as the ultimate hard currency. And the fact that gold has run up really should be framed differently. It's not gold has increased in value, it's that dollar and the rest of the global currency basket has declined in value, right? When put that way, right, there's no mystery as to why gold has become more expensive, right? Because gold probably hasn't done very much, right? It is that fiat currency, what global governments can't print at will, and that would be the dollar, right? Be the British pound sterling, right? It's the euro, it's the Japanese yen. When governments run up debt, they print more money to self-finance. There's really very little interest, and it's not just the U.S., right? The rest of the global governments are far worse than we are in terms of, hey, we'll just print money, yeah, we're not going to worry about paying it back. So currently, you have a systematic, gradual debasing of all the major currencies, and of course, by contrast, since you can't print gold, right? Gold becomes more and more expensive or value versus a global currency. So in some ways, what's happening in gold just reminds us of the decline in the purchasing power of your wealth, right? Unless, of course, you allocate it to equities or real estate that has a natural inflationary sort of indexing component, right? And so if you were just sitting in, CDs, right? This would have been a horrible run, right? Because you got very low interest rate and your dollar can't buy very much versus when you first deposited. So I think, gold is just a constant reminder to us, first of all, as an indicator of the loss in your purchasing power, right? It would have been much worse if not for the fact that we outsourced manufacturing and bought cheap goods back. Like, the loss in the purchasing power of your wealth would have been much more significant if not for that. And so gold is just a way to remind all of us. And that's why I think advisors should always have gold in their portfolio. First of all, for the inflation indexing, but second of all, it's just a great way to constantly remind yourself you're saving for retirement. Your biggest risk is that retirement dollar doesn't sort of catch up to inflation. And so that's kind of my view on gold. Always something to anchor your portfolio. It is the ultimate hard currency, and it's just very indicative of the erosion of your purchasing power, and then sort of keeping inflation front and center as you save for retirement. Oh,
Now
Bitcoin. And then,
yes, of course.
So whereas a lot of people want to talk about Bitcoin as liquid gold, right? Um, you know, maybe someday. I doubt it. Because like, you could always have a gold bar, and flee for your life, and count on the gold bar being good, right? I'm not sure Bitcoin is that portable, right? When things go bad, to transfer someone a Bitcoin from your hot wallet to their hot wallet, I don't know how easy that is. But so like, how would you think of Bitcoin? Now, I would say I'm now a adopted Bostonian. I grew up in California, but the last 5 years I lived in Boston. So Tom Brady, I'm going to use Tom Brady rookie year football card as an example, right? First of all, it is artificial scarcity, right? Of course, they can print more Tom Brady rookie cards, right? Back then and even today, and it look exactly the same thing, right? So it's artificial scarcity,
Mm.
but doesn't matter, right? It is scarcity. So think of Bitcoin as having attained the status of a major piece of artwork, a major memorabilia collectible, right? It has value because there is a large sort of group, a cadre of people who say, I give it value, right? We have an agreement that we're going to sort of trade it and give it value, right? It's like any artwork, masterpiece, right? You don't have to like the art as long as someone somewhere is going to pay for it, right? It has value. So think of it as a collectible, right? So don't think of a fundamental of Bitcoin, right? There's no fundamental to a Tom Brady rookie card, right? It doesn't give you a cash flow. It can't be assessed for value. You can't look at the components to assess like the replacement value. But once you attain a certain status, right, you cross over that threshold, right? Once you are the Tom Brady rookie card, right, not some unknown football player, who might, fade, right? That value is in a way almost permanent, right? So think of Bitcoin that way, and don't think of it as a currency because can you buy something with Bitcoin? Yeah, but it's because you can convert to the US dollar first, and then dollar can buy something, right? It is, under President Trump, we're going to be very friendly to Bitcoin, but certainly you could be in jurisdictions, let's say China, for example, where the government says, no, we don't want to allow Bitcoin. There's no convertibility of Bitcoin into Chinese renminbi, and all of a sudden it is not a currency anymore, right? Because you can't convert it into something that you can use for consumption. So, so don't think of it as a currency, right? It has a linkage to the dollar as a collectible, and the fact that it's sort of liquid in that sense, it allows you to exchange for something to buy, but it is not itself a currency. So it's a highly speculative collectible memorabilia for now.
Well, I'm not sure I want Tom Brady. I mean, I'd rather have Tony Romo after I've listened to Tom Brady on as a announcer. But anyway, I'll throw it to you, Daryl.
Great. You a little bit ago, you asked, or you had mentioned, kind of the transformative potential. I forget exactly how you phrased it, but the transformative potential of machine learning and artificial intelligence. But it could be anything else, like that an advisor can dream up. In terms of an advisor's collaboration with an OCIO or asset manager, how can they do that to take advantage of these technologies that you're talking about and to better align investment strategies with kind of client specific goals that they might be hearing?
Yeah. So there are obviously in a OCL offering to a financial advisor, you have multiple layers where value can be created, right? At the advisor level, it's about solving the client's wealth accumulation problem, his retirement problem, and it's a highly customized exercise, right? Because everyone's situation is different. Everyone's savings objective is different, right? Is it for passing on his legacy to his children and grandchildren? Is it for retirement consumption, right? Or is it just a big dollar sign creates mental safety and it allows him to sleep better and eat better, even if there's no consumption year mark for that, right? So it's a very idiosyncratic process, and therefore it's very labor intensive. So any technology that helps with customization can help. And what we're finding out is, of course, AI technology allows us to, I would say, more cost effectively customize, mass customize. Now, of course, that's kind of at the planning level, right? You also have at the asset allocation level, right? If you can asset allocate better, and we know asset allocation in a portfolio over a long run dominates 80% of the return creation in a portfolio. So if you can use data to inform decision better, to understand the macro transitioning, the cycles better, you're going to produce a better portfolio for the advisors versus a very sort of standard conservative 60-40 or 50-50 blend, right? Just being a bit more sensitive to these cycles and adjusting and reacting to that. And then, of course, there are the actual funds you invest in, right? I am a big proponent of sort of indexing cost-effective solutions, but also in markets where there are a lot of inefficiencies still. And from time to time, US does become that market as well, because historically we've been 5% retail. More recently, after COVID, we're like 30% retail. So we have become less efficient, right? So active management in the US could make sense with those numbers, but certainly outside of US, right? In emerging markets and developed Asia markets where retail participation can be as high as 50 to 60%, in EM Asia, even 80%. Applying a systematic, more scientific approach, using machine learning to create alpha will also boost return and make the journey better, right? So there's just these three layers where you want to bring the latest technology. Again, I want to go back to my first point, which is it's not a cure-all, right? There's a limit to how much alpha can you add against the S&P benchmark, given how efficient that market is. How much alpha can you add in an emerging market basket, given its high degree of inefficiency. There's a limit to that. How much can you, from tactical, from strategic rebalancing, add? Again, you can do better with more data, with better scientific approaches, but there's a limit to that. And then, of course, from a customization perspective, it just saves a lot of work. So for an advisor, these are the possibilities. Now, of course, you don't want to have to build those capabilities, right? So for any advisors, right, unless you have a $20 billion practice, it is a bad idea for you to say, I'm going to build instead of rent, right? Renting is cheaper, right? We live in the sharing economy, right? Ownership can oftentimes be a bad idea, especially if you want to own really high quality stuff, right? Like you don't want to own a private jet. You're probably perfectly happy being on a fractional private jet and use it only when you need it, right? And that's what sort of today, given the entry to be a good investor is so high, right? Because someone with machine learning, with a treasure trove of data will outperform you, right? That's why that data is expensive, right? That's why the people who can do this is expensive. So you don't want to build that. You want to rent that. And I would say in an OCIO format, it allows you to tap into that at a very high quality without having to build it. And I think that's really the promise of what Sowell is rolling out and making available is you have fractional ownership to one of the most blue chip institutional asset allocation and equity alpha team working for you.
That's great. That's a lot of clarity, and I like the jet example. That's great. I was excited to see that we have a question from one of our advisors, Josh. So again, if you have a question, please put it in the Q&A or raise your hand, and we'll let you ask that live. But Josh said, I recently heard a labor economist talk about the significant decrease in U.S. citizens having children. He mentioned that the primary driver in population was immigration. Do you anticipate the current administration's policies producing a drag on the economy moving forward?
So, the decline in birth rate is a universal problem. So if you think the US birth rate has sort of declined and we're alarmed, try Asia, right? Asia's replacement rate has fallen below 1, meaning every couple has less than 1 child, right? So it doesn't take more than a few decades for the population to halve, right? And we kind of go, wow, that's a big problem for Asia. No, that's a big problem for us, right? Because we outsource so much to Asia. The fact that we get cheap imports that really manage our inflation, immigration is a small part, right? yeah, this is better than immigration, right? We actually just move the work overseas and ask someone to do it very, very cheaply. So, birth rate declining in the US, of course, makes labor in the US expensive, but birth rate declining in Asia, like the manufacturing hub for the world, makes goods expensive globally. So we're kind of back to the same conversation around inflation, right? Whether it's our own labor decline, and of course, when we cut off immigration, that is going to sort of add additional pressure. But like the big pressure is actually the declining birth rate and declining labor force in regions that we have depended on to do most of our work, right? That's actually where the problem is, and that we can't fix by immigration. So of course, at the margin, restricting immigration will hurt us. That's for sure, right? I mean, not only do we depend on immigration to drive a lot of the manual labor to keep the service sector wage low, we actually also depend on a lot of foreign immigration to drive all of our great tech firms. Right? If you look at Silicon Valley, right, the great firms today are led, managed, and oftentimes staffed by immigrants, right? And that's been the biggest driver of our stock market wealth or our GDP. So, we could hurt ourselves unintentionally on both fronts. And that is a danger that we should, as we sort of think about policy setting, that is something we should take into account of.
Right, for sure. Greg, did you have another question there?
Yeah, if we don't, I was looking to see if we had any other questions, but just as we wait for that to throw out, again, I heard an interesting comment by you. The customization today to really help advisors is really in the pursuit of beta, right? Not the obsession over alpha. The Rayliant products that we're going to integrate into the OCIO. Talk a little bit about sort of this concept of beta being the driver of wealth accumulation and how customization in that regard might be most important.
Yeah, so Greg, this is a great point. And so here, I get to, talk about my sort of favorite phrase, smart beta, right? So my entire career, at least the first half of it, associated smart beta, right? I'm credited for inventing this new category, new way of investing. So what is smart beta? So think of S&P 500, think of, the MSCI indices as bulk beta, not dumb beta, as bulk beta, right? Like, if you think of standard indexes, right? It's like just the biggest names and they're weighted by their total market cap. And that's just a fancy way of saying the bigger the company, the bigger the weight in the portfolio. And when you think about that, right, sometimes companies get big because they're super profitable. Microsoft, Walmart, they're gigantic because they're profitable. They just make a lot of money. They sell a lot of goods and services. But sometimes a company could get really big because they're hyped up and become very expensive, right? So if you just weight by, size, sometimes you almost have bubble weighting, right? Any unreasonably priced expensive stock will have more weight in the portfolio, and just sort of passively buying a lot more of what's gotten expensive probably isn't particularly wise, right? Certainly doesn't go in line with, I would say, Warren Buffett's concept of value investing, right? Don't hold anything that's become too expensive. You should focus on the fundamental, not on the price, right? And so I think there's just a lot of things you can do in sort of reformulating the beta. And, a lot of what we've done in academia is like, well, if you don't naively just weight a portfolio like S&P 500 do by the size of these company, by the price of the stock, what are the things you can look at? And something we call multi-factor investing. That's just a fancy way of saying, let's look at instead the fundamentals that should drive long-term share prices, right? All the accounting metrics, right? Their capital structure, how much debt do they have, how profitable are they, how fast are they growing, and what are the insiders doing because they're very well informed, right? What's sort of the dumb, hot money doing because they, in the long run, generally tend to lose money. So if you take all these reasonable fundamental and instead use that to weight your portfolio to create a beta for you to sort of hold in the long run, right? It makes sense you can do better. And then that's a lot of my early on research in the early part of my career. It shows that, yes, if you do this, it works well. It works well in the US. It works really well in emerging markets where there's a lot more information in the fundamentals because it's not as competitive and then not fully exploited. So, it's absolutely right that this focus on smarter beta is helpful. And sometimes it's not even you're able to buy better companies. Because I think, the companies in our S&P 500, right? They're the Magnificent Seven are great companies. But we also know diversification is the ultimate free lunch, right? So is buying 7 companies in the same industry well diversified? First of all, 7 is not diversified. We only got to get to at least 30 to be diversified. And also 7 companies in the same segment is definitely not diversified, right? And if you passively track the S&P 500, that is what you get, right? You get basically concentrated holding in one industry. So you probably, even if they're great companies, you're probably better off being a bit more diversified, right, across the industry sectors and not just so growth oriented, right? Have some focus on value and cash flow could be a good thing, right? Because again, you probably create a great wealth riding the S&P up, but you're probably at a point in your wealth where there's a huge asymmetry, right? Make another 20%. Does that foundationally change your ability to retire? But lose 20%. That's going to delay retirement by a very, very long time, right? So you may be at the point where you kind of go, I had a great run. I got lucky, or my advisor is very good, right? I think it's mostly because the advisor is very good, right? Some moving away from these concentrated traditional beta to smarter beta, be more diversified. It's probably the right thing to do.
Yeah, I think what you're saying is that all beta is not created the same, and we need to be careful. We're coming up to the end here. I was going to throw it back out to Daryl.
Yeah, I've got this will be our last question because I know we're 1 minute over right now, but I think it's a good one. The question is this: what kind of access will Sowell affiliated advisors have to Rayliant through Affinity Sal? That was a mouthful. Appreciate the question. We'll simplify this, right? You're going to see Sal Rayliant anymore, and that has been a strategic alignment that Greg and Jason have orchestrated. So you can simplify it. So therefore, the same access that you've always had to Alex and Greg now gives you access to the full suite of research and products and services that Rayliant has. So we're super excited about this, and I'm glad someone asked this question because if you think about the content of this conversation and it's stimulating to you, you're thinking about how you might want to personalize and customize portfolios for your clients, or you have clients asking for it. We're being very intentional about building out this capability through reimagining our OCIO offering with increased benefits and features. So same 2 people leading the charge in Alex and Greg, but many more, and I would say much more horsepower behind them. Not that they didn't have great horsepower before, but I guess I say it this way: 2 eyes are better than 1, and so we might as well have the addition there. So I would encourage you, even if it's been a while since you've talked to Alex or Greg, that you reach out to them. We're going to be sending a follow-up email to this webinar as well, just as a kind of a call to action to you, a reminder to kind of take action on some of the things that you've heard today, so you can incorporate these in what you're doing for your clients. So that'll be really important. We're also beefing up our ETF offerings inside what our advisors have access to, what we're placing inside portfolios, just to give some differentiation and in some ways, right, to intentionally build on some of the things that Jason was talking about today. So there's a number of ways that you can follow up, but now Rayliant's full capabilities are incorporated into Sal's platform. You'll hear and see more about this as the year goes along. So great question. Jason, thank you so much for joining us today. We've thoroughly enjoyed having you, being with you. And I know you're busy since you're on the bridge there running the USS Enterprise, so we'll let you get back to it. But Greg, thank you very much for helping me host this with Jason. And we look forward to bringing you much more content on investment management and OCIO throughout this year. Thanks again, everybody.
I just want to say before I sign off, Greg Lai was a legendary portfolio manager before I got my career started. So, I am, just, so excited to be here with someone who's legendary, who's been such a mentor to many in the industry.
Absolutely.
Wow.
We're just going to
Thank you.
keep building and building this great team. So, and together we'll be able to accomplish a lot for each other. And of course, for the retail clients that we all love and serve. So have a great day, everybody. Thanks for being with us.